Mike, so Goldman Sachs sent a bunch of their investment bankers 10 years forward in the future using their proprietary time machine technology.
They did.
And they came back and said, hey, we think the S&P 500 is going to return just 3% per year over the next decade. Now, Goldman Sachs does not actually have a time machine. They didn't actually do this. But
And if they did, can you imagine anything more boring to predict than what the S&P 500 is going to do over the next decade?
what do you mean? That's like the most exciting thing that you could do. Do you know how much money you could make if you
could
could
make a
predict
killing
exactly
if you
what
could
the
predict
market's going to
exactly
do
what
for the
the
next
market's gonna
decade?
do. Yeah, you can make a lot of money.
Holy cow. Like, my goodness. In any case, if the S&P only returns 3% a year over the next decade, that puts it in the 7th percentile of returns for decade-long periods historically.
Going back to what, like 1940s, 50s, 60s?
I think this actually goes back to like the 1920s using the data that they have.
Okay.
1930.
So when you
Pre-S&P
run
500 when it was called something else.
rolling 10-year periods, this would put you very close to the bottom of them if we did get here.
Correct. On the other hand, for the last 10 years, the S&P 500 has returned about 13% a year. That is in the 75th percentile for historical returns.
I would have guessed higher.
No, there have been higher ones, actually.
Yeah.
Quite a few. And so, ultimately, it's something where, look, none of us know what the returns are going to be over the next 10. And I think this is something important also, that even as you're going through it, it's not easy. I mean, look back at the last 10 years, which started in 2014, and think about all the stuff that we could gnash our teeth about during that time period. It's not something where you just sit there and say, well, I'll just set it and forget it, and it's, an easy... No, like, as much as all of us talk about, hey, just don't look at your portfolio and, let the market do its thing, we're all human. We all, see the news. Oh, gee, Russia invaded Ukraine. We're really nervous about this. Hey, there's an election coming up. I'm so nervous about this. Hey, COVID is happening in China. Do you think this means anything? Like, we've all been through all this stuff, and as you're going through it, it's hard to remain rational. And also, by the way, there's no guarantee that even if the same stuff happens over the next 10 years, like let's say you have the exact same things happen, it's Groundhog Day.
Yeah,
the market,
deficit goes up another 40%.
The market might not perform the exact same way, even in the same set of circumstances. You could be like, well, look, I'll just hold out, and maybe the market does return 3%.
I have a few takeaways from this. I mean, one, this is a 3%. Who knows? Nobody knows. Good as guess as any other, although well below averages over any period of time. This is one of those areas, you know the phrase or the disclosure that's on every single investment you've ever looked at, which is past performance is not indicative of future results. In the case of like broad-based indices, you can almost take it like the reason Goldman Sachs feels this way is because actually the past performance over the last decade in U.S. equities makes the future results even more difficult to accomplish.
Correct.
You could take it to the step further, saying like past performance might actually be negatively correlated to future results in these cases. The other piece I would add to all of this is if you have built yourself some sort of financial projection and financial plan, or if you work with a professional who does so for you, one of the first questions you should ask about those projections are, what are you assuming my money will grow at over the lifetime of this? If somebody's not tested, like I'll tell you, if the markets actually do return only 3% over the next decade, or let's take that a step further. Like let's say they only do 3% over a couple of decades, which would be almost unheard of. There are a lot of financial plans that I've personally seen that are not going to work.
Correct.
Like they are going to fail in spectacular fashion. There would be pension funds that would not be able to keep pace. There would be really big problems if U.S. equities can only perform at 3% for an extended period of time, basically not beating inflation. And so that's the only addition I have on top of all this is, this is interesting conjecture, but to bring it home to the regular person out there, if markets only do 3% for a prolonged period of time, you better hope you have a whole lot more saved than you were anticipating needing because it's going to stretch you thin.
And none of this is to say that the market, like, none of us know what the next 10 years actually holds. That's what makes it both so, like, on one hand, kind of exciting, but on the other hand, like, I'm going to throw up. Like, it's, it's like none of us know what's going to happen. It's just, it's kind of nerve-wracking.
Yeah, sure.
But ultimately, I come back to this over and over with investing. And I'm specifically saying investing and not trading, because those are fundamentally different things, and I think oftentimes we get confused talking about them. If you are investing in anything, number one thing that you have to do is say, look, I need to match, my liabilities when I need money to what I actually own. And stocks are a horrible vehicle for matching liabilities in the next decade. Like, if you need money in the next 10 years, it shouldn't be anywhere near the stock market. Really shouldn't be. I mean, you can make a case like 5 to 10 years. Okay, like, yeah, that money you maybe could if you have a high risk tolerance.
Sure.
But otherwise, what are you really doing? I mean, you have no idea. Just because the last, 15 years has made you feel that nothing can go wrong, and if you buy the dip, it's always going to work out. There are a litany of market periods where buying the dip was like the worst thing you could do.
Yeah, because it dipped another 50%.
Not for the long term, but for the next 5 to 10 years. Yeah. It was an awful decision. Like, if you bought the dip in 2001 on the NASDAQ, it took you 14 years to get back.